Okay, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer how we start each of our podcasts. Nothing in this podcast or any of our other content should be taken as investing advice. We are simply exercising our First Amendment right to share our opinions with the world. And we may have positions in any of the stocks that we talk about in these podcasts and close them, open them, short, buy at any moment without notice. So you should always do your own investing research and consult a professional before making any investment decision. With that being said, today we're going to talk about GameStop. So you probably remember GameStop from back in 2021, the mother of all short squeezes, when it went up by 100 times from just a couple dollars as a company kind of on the brink of bankruptcy, spiked up on retailer investor hype, up to above $400, and with a bunch of famous hedge funds shorting the stock, losing a lot of money. Since then, though, the stock has had a lot of changes, and the stock has kind of trudged lower from the highs over the course of the past 2 years. And some interesting developments have kind of been happening over the last several months that make GameStop kind of worth revisiting. So, James, I'll hand it over to you. What has changed over the course of the past 2 years since the mother of all short squeezes? And does that change anything about GameStop as a stock?
Yeah, so GameStop is a really interesting situation, obviously, because we have the backdrop of the short squeeze. And in this presentation, we're going to first go over the fundamental backdrop from before the short squeeze, why the business was kind of failing in the first place, and why so many hedge funds were short the stock. Then we'll look at what has changed after the short squeeze and whether or not GameStop can be a viable business. So the GameStop has suffered from deteriorating revenue and profitability over the past few years. You can see kind of going into from 2017 through 2020, which was the pandemic, revenue decreased substantially. Following the pandemic, there was an increase in revenue because pretty much all brick and mortar retailers did well in 2021 and 2022 because of all of the stimulus checks and enhanced unemployment, where consumers had more money. But one thing to note is that since 2019, GameStop has never reported an annual operating profit. They've been losing money ever since 2019. And if we look at their revenue by segment, we can get a little bit more understanding of what's going on. So, in case you don't know, GameStop, they sell video games. They have three main things that they sell at their stores. One is the hardware. So that's like your Xbox or PlayStation or Nintendo Switch. Second is software, which is the games for these devices. So you can buy the disc, the video game disc from GameStop. And then the third thing they sell is video game collectibles. These are like accessories that go along with the video games, and they also sell some other collector's items such as Funko Pops and the like. So the main thing that has really caused the decline of GameStop is the decrease in software sales. So that's the games themselves, the discs. And the main reason for that is because now with the Xbox Play Store and the PlayStation Play Store and the Nintendo eShop, you can buy video games downloading them directly online. And if you can download it directly online from the comfort of your home, there's not really any reason to physically go to the GameStop store and buy the discs. So that is sort of the backdrop, is that GameStop's core value proposition of selling video games has been disintermediated by the console companies themselves, because now you can download the games directly onto your console. And over the years, as GameStop's business has deteriorated, they have closed a huge number of stores. You can see in this gray line here. So back in 2017, they had almost 6,000 stores. As of 2022, they're now down to only 4,500. So they've closed 1,500 stores. Now, despite closing a large number of stores, their revenue per store has been about flat, and their gross profit per store has been declining. Now, this is a very bad sign because when you, as a retailer, are closing your stores, you're going to be closing your worst stores first and keeping the better performing stores. So, even despite closing a huge number of their underperforming stores, the remaining stores still aren't doing that well, and the company is still losing money. So these two charts, this basically shows the reason why GameStop was failing in the first place and why so many short sellers were shorting the stock. Now, a lot of things changed with the short squeeze in 2021 and with Ryan Cohen buying a huge stake in the company and installing himself as chairman. The first big change was that shortly after the short squeeze, GameStop's stock price was very high. And the company took advantage of that by issuing a huge number of new shares and raising $1.1 billion. So that put them in a much better financial position. And then with Ryan Cohen now being the chairman and essentially controlling the company, he had a couple of ideas of how he was going to turn things around. So the first is he was going to focus on e-commerce, and that's with you can buy games and order them to your home on GameStop.com. And the second initiative he had was to expand into crypto and NFTs. So we'll look at these two expansion plans and see how they turned out 2 years later. So on the e-commerce side, the GameStop.com e-commerce has been a complete flop. The company does not disclose their revenue of brick and mortar stores versus e-commerce, but some of the commentary that they give has been leads us to believe that e-commerce has not been doing too well. So in the second quarter of 2023, second calendar quarter of 2023, which is the most recent one they reported, they said that e-commerce volume decreased compared to the same period in the prior year. So if e-commerce was supposed to be your big initiative that you're going to turn around the business, well, that's obviously not working out because e-commerce volume has decreased, at least in the first half of 2023. And the main reason for this is that GameStop's main competitor is not Amazon or eBay. Their main competitors are Xbox, PlayStation, and Nintendo. And no matter how efficient you are as an e-commerce operator, no matter how efficient you are at shipping things to people's houses, you can never beat the eShop where you download the game at no additional cost directly onto your device. So e-commerce isn't really going to save them because that's not the threat is digital downloads, which GameStop cannot compete with. And so the next pillar of the expansion plan was to get involved in cryptos and NFTs. So in 2022, GameStop launched a NFT wallet. And the idea was that in various video games, there are in-game items that you can buy. And then with the GameStop crypto wallet, the idea was you could have those in-game items tied to an NFT, and then people can collect these NFTs and trade them with each other, and they would connect to in-game items. Now, the NFT marketplace, the GameStop NFT marketplace was a complete flop because in the 3 and 6 months ended July 29th, 2023, they said that digital asset wallet and NFT marketplace were not material to their financial results. That basically means that the revenue they generated from the NFT wallet was more or less a rounding error. It was too small to matter. Not only that, But now with the SEC increasingly cracking down against crypto and NFTs, uh, GameStop says that they're going to shut down their NFT wallet just because they don't want to get involved in that. So this has been a complete flop. And then another thing related to crypto that they did is on September 7th of 2022, GameStop announced a partnership with the crypto exchange FTX. And as part of the partnership, they were planning that you could buy FTX gift cards at GameStop brick and mortar locations. Now, as all of you probably know, FTX was exposed as a fraud and collapsed. And it collapsed in November of 2022, just 2 months after GameStop formed the partnership with them. Now, this, in my opinion, shows a lack of judgment on the part of GameStop's leadership that they obviously had not done sufficient due diligence on FTX prior to forming the partnership because they didn't know that the thing was a fraud that ended up collapsing just 2 months later. So the whole crypto and NFT venture from GameStop has been a complete flop. And recently, we've had some more concerning news. So, shortly after Ryan Cohen took over as chairman of GameStop, he fired the old GameStop CEO in 2021, and he hired this new guy called Matt Furlong. Matt Furlong previously was an executive at Amazon. And the idea of bringing him in is that he has significant expertise in e-commerce. So he would be able to help revitalize and grow GameStop's e-commerce operation. Well, as we talked about previously, the e-commerce has been a flop. So this really hasn't worked out. Now, on June 7th, they announced a press release where they said that they fired the CEO, but it was announced in a very strange way. The headline of the press release was GameStop announces election of Ryan Cohen as executive chairman. So previously he was just the chairman, now he's the executive chairman. And then, kind of down here in the fine print at the bottom, it says, in conjunction, the company's former CEO, Matt Furlong, has been terminated. So it was kind of, they don't want to talk about it at all. And they just put it down kind of in the fine print of the press release, not even in the title, that they're firing the CEO. And it's very strange. It's like they're not giving investors any information as to what caused this. And this also kind of goes to the judgment of Ryan Cohen as the chairman, because he's the one who hired Matt Furlong in 2021. And then within two years later, he's firing him in this really strange way. And GameStop has not announced a new CEO. They have not even announced an interim CEO. It appears that Ryan Cohen himself, as executive chairman, is also unofficially fulfilling the CEO position. But as investors, their press releases and disclosures are so minimal and so weird that it's really hard to know what's going on and what Ryan Cohen is thinking. So that's always, a red flag when you don't even really know who the CEO is. I mean, it's like the company doesn't have a CEO. And then, so kind of everything we've talked about up to now is that GameStop was failing as a business due to being disintermediated by the online e-shops where you can download the video games online. They have Ryan Cohen had two turnaround ideas, e-commerce and NFTs. Both of them have been complete flops. So the fundamental bear case of GameStop, that it's a dying business, that there's basically, that's being disintermediated, that none of that has changed. But the stock price is still very elevated compared to where it was before the short squeeze. And this kind of goes to the whole meme stock mania and the fact that a lot of retail investors still have an affinity to GameStop just because of the short squeeze and all the hype around this. And the hype around the GameStop short squeeze is so much that Hollywood has created a movie called Dumb Money, starring Seth Rogen, which is all about the story of the GameStop short squeeze. And I think this is a really dangerous thing for retail investors because you're glorifying um, this short squeeze, which is fine, except for the problem that the majority of retail investors who invested in GameStop have lost money um, because after the short squeeze, GameStop took advantage of the elevated share price to issue $1 billion of new stock, and that stock has declined by about more than 50% since then. So, who was buying that $1 billion of new stock? It was not hedge funds covering their short positions. It was retail investors who are now sitting on massive losses. So, in total, GameStop has really been a net negative for retail investors because most people got in late, and the number of shares increased massively after the short squeeze with the equity raise. And that's when most of the retail investors bought in and lost huge amounts of money. So, don't get caught up in all of this memes about the GameStop movement. Being dumb rarely pays. And as we just talked about, the fundamental bear case for GameStop, the reason why the short sellers like Andrew Left and Gabe Plotkin shorted the stock in the first place, all of those bear cases or all of those problems are still valid today. GameStop is still a declining business that is losing money, and there's no realistic path for them to turn things around. The reason why the short sellers ended up losing so much money is not because they were wrong on the fundamentals. The problem was they got way ahead of themselves and shorted way too much of the stock. Now, at the time of the short squeeze, or right before the short squeeze, GameStop's short interest was above 100%, which is obviously a huge amount of short interest. That means individual shares of GameStop were shorted multiple times. Now, when you have such a huge amount of shares shorted, this creates a very fertile environment for a short squeeze, which is what happened. Now, since then, the short sellers covered their losses, or the short sellers covered their positions at huge losses. So that caused the short interest to go down. Also, the number of shares increased massively because GameStop issued $1 billion of new equity. So now the free float is much bigger and the number of shares shorted is much smaller. So currently, according to data from marketbeat.com, GameStop's short interest is hovering at around 20% over the past year. Now, 20% is an elevated short interest compared to the average stock. The average stock probably has a short interest of just 1 or 2%. But with only 20% of the shares shorted, that is a very different situation than what we had in the beginning of 2021 with over 100% of the shares shorted. So now the short interest is much more reasonable. The chances of another short squeeze, in my opinion, are substantially lower. And that, in my opinion, makes GameStop a good shorting opportunity.
When I think about GameStop, and James, tell me if you think differently, but I think like a reality of the economy is that there's some industries that were viable industries in the past, but just kind of die, like become unviable. Like for example, landline telephones used to be a huge, like very profitable business, but when cell phones became ubiquitous, the industry just doesn't exist anymore. As far as the fundamentals of GameStop, maybe that's kind of what's going on. Like you see that Ryan Cohen's initiatives with NFTs and e-commerce are kind of um, completely different from what GameStop's traditional business was. And doesn't that just kind of go to show that what made GameStop successful originally is just no longer reality and never will be?
Yeah, I think that's really the key point here is that you know each time a new console is released, the Xbox or PlayStation or Nintendo, the amount of storage in the console increases, And also, people's internet speeds get better over time as fiber and high speed internet are rolled out. So, over time, the ability to download games directly onto your console um, increase just gets way better. And it's a way better experience than physically going to GameStop. So the software business, the selling of the physical discs of the games, that is a declining business. It's been declining very quickly over the past few years, and it's going to continue to decline and probably get to zero or close to zero. At that point, the only things GameStop can sell are the devices themselves, as well as the collectibles. But that is not enough to cover all of their overhead costs of operating the stores and also their corporate overhead. So, as the revenue is declining and is almost certainly going to continue declining, there's not really any way for them to become sustainably profitable as they decline. And any of these, as you said, like any of these initiatives, like the e-commerce, it's just not going to work because it's not solving the fundamental problem. So they hired this Matt Furlong, a former executive from Amazon, and he's supposed to revitalize the e-commerce business. But it doesn't matter how good Matt Furlong was as an e-commerce executive, you're giving him an impossible task. Like it doesn't matter. You could hire Jeff Bezos to be the CEO of GameStop. He still wouldn't be able to turn it around into a successful e-commerce company because e-commerce simply will not work for the video game industry.
And as far as like the interest from retail investors, I'm just speaking for myself here. Again, nothing is investing advice, but anecdotally, I feel like I know for a fact there are a lot of people, like young adults, who have a lot of good memories from when they were kids around GameStop stores, right? Like they go to the
Mm-hmm.
mall with their family on a Friday evening, have dinner, and then it's like, mommy, daddy, let's go to the GameStop and like try out all the new games and maybe try out the new Xbox or PlayStation. And like on the one hand, it's kind of sad for these people to see this part of their childhood kind of go by the wayside and be uh, like no longer a viable business. But that also, if you think about it from an investing standpoint, makes it more dangerous, right? Because whenever you bring in an emotional element to an investment idea, then you're kind of probably more predisposed to think high, like think of glass half full sort of thing, even when the fundamentals are kind of screaming the opposite.
Yeah. And
And
obviously,
you see that with the Dumb Money movie, right? Like this is completely basically like appealing to that sentimental aspect of GameStop, and also the sentimental aspect of the short squeeze too. But it all goes back to how people think of GameStop.
yeah. I think it's just something that, as an investor, you have to view the world as it is, not as you would like it to be. A lot of people would like to have believed that, oh, there was this big short squeeze and the hedge funds were wrecked. And with the great genius, Ryan Cohen, he's going to turn everything around and it's all going to be happily ever after. But as we can see, looking at what's happened over the past 2 years since Ryan Cohen has taken over, none of that has played out.
I would say like if that's how you feel about like sticking it to the man and stuff like that, after the initial short squeeze happened, I would say like take the victory, right? And don't put more of your money at risk over the course of more than 2 years into the future, right? Like you already for those who were in before the short squeeze, you already made your money. The hedge funds already lost their billions of dollars, and there's no reason to drag it out when you're just going to lose your money that you just made.
Yeah. All right. So I think that about wraps it up for everything we had to talk about GameStop. As always, we love to hear from you all in the audience. What do you think about GameStop? Is there anything you think we missed? Please let us know in the comments section below. And with that being said, we'll see you on the next one.